Welcome to Trends with Benefits, a podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, investing, work, and life. Here's your host, Ed Lopez.
Welcome to another episode of Trends with Benefits. Today, I'm going to try to tackle ESG. For the uninitiated, ESG stands for environmental, social, and governance. And it's a form of investing by which investors can direct investment dollars towards companies and fund strategies, if you will, that reflect their core values. It's a big topic. It's a more popular topic in recent days. And to help me kind of wade through this, I've invited Mark Sloss, founder and CEO of Regenerative Investment Strategies, which is an ESG consultancy helping asset owners and asset managers to define and to practice sustainable and impact investing, reflecting a core set of values grounded in strong ESG practices. He's also a partner at Wild Capital Management. Mark, thanks for joining me.
Thanks for having me, man.
Did I define ESG appropriately, do you think?
I think it's a good place to start. It's a big tent. There's a lot of jargon out there. We'll probably end up using a bunch of different terms referring to the same thing over the course of this podcast. So I think we just go with it.
Yeah. And you've been in this field, in this ESG field for quite a while. You started Regenerative in 2016?
Correct. Yes.
And then prior to that, you were at UBS Wealth Management for a little over 11 years within the investment management framework, doing, involved in sustainable investing for a long time, right?
Yeah, exactly. So my day job, if you want to call it that, was principally in the areas of manager research and multi-manager, multi-asset portfolio construction. But my sideline was working on sustainable investing strategies. UBS, as a global bank with a European heritage, was, I think, karmically predisposed maybe to be a good place to explore some of that stuff. And so it was fertile ground for me to really cut my teeth on the subject material. I had come to the firm already steeped in it, but it was a chance to really kind of grow into it and understand it both from the asset manager as well as the wealth manager's point of view, and touch both sides of it, get involved with a lot of non-governmental institutions and academics and the like, and stretch my mind and kind of brought me to the precipice where I was able to step off and start with Regenerative.
That's great. So here's a couple tidbits from the news, just to talk about its recent popularity. Morningstar recently noted that sustainable fund flows in the U.S. reached $21 billion in the first half of 2020, nearly matching all of 2019's record year. And then the FT also reported, using data from ETFGI, that ESG ETFs saw net inflows of $32 billion globally in the first 6 months of 2020. And that was more than triple the $10 billion in inflows witnessed same time last year. Given your long tenure in the space, does it seem like sustainable investing's time has finally come?
I think so. And it's been a long time coming. If you talk to enough people who've been involved in this part of the industry, you'll find that this is decades in the making. In a lot of regards, it's not a surprise where we are now. I think 2020 being a year of trauma probably has helped to accelerate that to a certain degree: market trauma, societal trauma, public health trauma. But you can see it was building for years prior to this. And the impulse was kind of staged and ready to go, both from the market point of view and I think a demographic point of view.
So you've been part of it for quite a while, and I've been in the industry over 20 years myself, and I feel like there's been different forms of it. We started out talking about ESG, but I remember, a sleeve of it. I don't know if it's quite the same thing, or maybe it's just the S part of SRI. Can you talk a little bit about what the differences are between sustainable investing, which is also interchangeable with ESG, it seems, SRI, ESG? How do you look at this space?
I look at it rather than distinguishing between terms and acronyms, more on a continuum of development. And you made the right allusion there to where we're coming from. And the first label, I suppose, that was slapped onto it was socially responsible investing. And that was based on the notion that there was a more kind of ethical and aware way to go about making investment selections, with an earnest belief that that should actually line up with good investment outcomes as well. It was certainly harder to quantify at the time. So, the data, the systems weren't available, and frankly, the experience wasn't there yet. But I think that those in the industry who chose to do this sort of intuited that it wasn't incompatible to say that companies that did good things probably would be richly rewarded by the economy and by the market in the long term. As that developed, it became more, I would say, data-driven and evidence-driven. So less from the heart, a little bit more from the head. And that would probably be where you would point to the early days of ESG, where you're starting to break it down into these factor families almost. So you have environmental factors and societal factors and governance or ethical leadership factors. And that there was a relationship, approvable relationship between looking at, and we're still talking about companies in this case, looking at companies that were making positive moves in terms of their corporate behaviors in those three areas. The positive consequences to the environment, to society, but also the positive outcomes for the company and for value creation. And that there was an iterative benefit there, that those companies tended to be more innovative, more forward-thinking, more flexible, more nimble, better managed in terms of on and off balance sheet risks. So that kind of carried it forward from there. We arrived at a point where I think there was a third turn and bringing those two notions together. So the pendulum sort of swung from this place of saying it was all about the heart to it was all about the head. And now we've kind of come back to the middle and saying that those two things don't have to exist independently. They actually are facets of the same thing at the end of the day, and that there's not any kind of an internal dissonance there saying that companies that do good shouldn't do well. And that actually plays itself out also in terms of the fixed income markets and municipal securities and real estate and natural resources. And there are a lot of different areas where this actually manifests itself.
Yeah, I remember I guess towards the early days or early part of my career anyway, and looking at these strategies, or people when they would consider these different types of strategies, always knock them for poor performance. I don't know if you have any thoughts about that in terms of the perception of performance concessions in these types of strategies.
Definitely. And I would describe that mostly as a mythology that's been built up around this idea of concessionary returns. There is a discipline within sustainable or responsible or impact investing, whatever label you want to put on it, which is specifically focused on concessionary returns. When we're talking about it broadly, this notion of concessionary returns, I think it's commonly accepted that this largely came out of the South African apartheid divestiture movement. We all know how that ended up, and it ended up where it was supposed to and where it needed to. There was major societal reform that needed to take place in South Africa. What was coming from the Western world, and particularly North America, was this idea that you didn't want to invest in companies which were participating in, supporting, or benefiting from an apartheid social system. Problem was, at the time, if you looked at the Nifty 50, most of the marquee name brand type companies that were publicly traded were doing business to varying degrees in South Africa. It was a fairly vibrant market. That's a very, very particular kind of decision that has performance consequences. It could have been a good thing if there had been a small cap rally, and in this case, it wasn't such a good thing performance-wise. And so as a consequence of that, those investors that made that choice to prioritize divestiture from apartheid over other things may have seen a concession in terms of returns there. But that's one specific instance. That's not to say that it couldn't happen again. But I think what we collectively took away from that is that the framework that you put around ES and G decisions has to be carefully calibrated. That's really the only moment, I would say, in the 40 or 50-year history of these types of strategies where you can look at it and say, there's a performance disadvantage there. But since then, the idea and the reality just don't seem to line up. And we're definitely at a moment in the market where if you are experiencing what you perceive to be concessionary returns in an ESG strategy, chances are that's just a deficit on the part of the manager not doing a great job, more so than something intrinsic to ESG itself. And since there are more and more funds and more strategies every day coming into the market, pick another one. It can be as simple as that.
Yeah, that's interesting. It seems today there's more being written about the performance advantages of ESG, particularly in light of COVID. Some reports have come out that ESG-oriented strategies had lower volatility and lower drawdown. I don't know, what's your take on that? Is that a consequence of their ESG positioning, or are there other factors at play?
Probably both, to be perfectly honest. I think when you look at the community of ESG strategies taken in totality, you can probably see some biases emerge, which you can characterize in very traditional market terms like quality. I think that there is generally a quality bias across ESG strategies. They tend to be, at least on the active side, very fundamental, very bottom up, very picky about the types of risks that companies are taking or the types of risks that bond issuers are taking. That's going to manifest itself under times of market stress. No question, they outperformed in the March-April timeframe when things were really coming unraveled in the global markets here. We saw the same thing back in the 2007, 2008, 2009 timeframe with the financial crisis. I think to a degree that's that quality orientation playing through. And the rest of it, I believe, is some of the natural biases that are going to tend to emerge when using this kind of a lens to assemble portfolios.
Has ESG become a factor like other factors, or is it just another overlay to investment management?
That's a great question. And that gets back to the earlier points about terminology. We get caught up in this space where ESG is either used as a descriptor in an overly broad way or an overly narrow way. No, I don't think you can describe ESG as a factor. There are too many moving parts to it. There are too many considerations. Grouping ESG as a thing in the market would be sort of like grouping mutual funds or hedge funds as a thing in the market. It's a very big tent. There's a lot of different things going on under the banner of ESG or under the banner of hedge funds. It's not something that lends itself to saying, there's a factor I can pinpoint and say this has high explanatory power.
Kind of based on that, I would assume that it's hard to determine if there's the relative importance of the E, S, and G. I guess where I'm coming from is I tend to think that governance seems to be a very important part, that companies that are well governed and good governance policies might tend to be better on the E and the S part. I don't know if you have any thoughts about that and the relative importance of the E, S, and G.
Yeah, I think that's a really good observation there. And I would tend to agree that all things flow from the G, particularly when you're talking about companies, because companies reflect their leadership in terms of their behavior, their culture, their strategy, the markets they participate in, how they compete, how they innovate. Leadership and the ethical framework that defines a company, or frankly, a market or an economy or a nation, is going to have a lot to do with outcomes. It's the decision-making at the G level, which I think expresses itself in E and S terms. So I think you can almost look at big G governance as something of a leading indicator. I think it would be pretty rare to find a really great G score on a company if you really just mashed it down into a single factor, a single number, where the G and the E and the S are pointing in opposite directions. I think that one naturally leads to the other. I think a high-performing company in ethical and environmental terms that has poor governance and poor leadership scores, it just seems like a really unlikely outcome.
So then what's the best way to approach ESG? Do you think it's better approached as an active decision, active management decision versus an index-based decision? And what are your thoughts about the way the industry has rolled out new ESG products?
My experience, at least thus far, has been that ESG from the investor's perspective, so an individual, a family, it's a much more active, fundamental kind of thought that gets you into the conversation in the first place. And it's probably because that capital allocator cares about something, and that's why they're starting the discussion. It's not necessarily coming from, I think if we do this, we can eke out another 25 basis points of alpha, or maybe we can up the Sharpe ratio. They're thinking, we have a young workforce. They care about economic justice, or they care about environmental justice. And so we want to make some options in their 401k plan align with how it is they see the world, or a family that's going through a generational transfer of wealth, and you're going from the wealth creators to the wealth inheritors, and the inheritors are thinking more about things like social justice. So that's where the conversation tends to start. And with that more active mindset, I think it lends itself to more of an active management discussion. I think there's a reason that index strategies and ETFs have kind of lagged. I mean, you made the note earlier in this conversation about there's been significant flows in the ETF space, and that's true. But if you were to chart a line of the ESG ETFs as an asset attractor versus kind of traditional ETFs, you would see that the ESG ETFs were kind of, such as they were more or less flatlined during a lot of the big run up. And I think it's a bit of that bias against the machinery. I think there's an expectation of human intellect and maybe a bit of caring and compassion in there, along with the desire to participate in the capital markets and make appropriate risk-adjusted returns.
Yeah, it's been so tough for us to launch ESG strategies because we haven't gotten our head around what is the best approach. And there's so many different approaches out there now. You talk to different investors and they're more interested in different parts of the ES&G format, or they just want to be totally exclusionary, leave out all the sin stocks, for instance. So it's been tough for us to put our head around which way to go. Can there be a better ESG methodology than other ESG methodologies? Is there a better approach, or is it, in your opinion, just important to do something in the realm? If you're interested in ESG in any form, just more important to just do something. Doesn't really matter the methodology.
Yeah, I think methodology matters to a certain degree, but mostly that's around the intentionality of the investment. What are you trying to achieve with it? I don't think that there is necessarily any one exclusive right answer, though, by the same token. That would be the same thing as asking, is there a right way to invest in equities? Or is there a right way to invest in precious metals or natural resources? No, there are a variety of different ways to go about doing that. And I think it's the same thing with ESG. So some of it is rooted, I think, in connecting with the intent of the people that are asking for these investments in the first place. What are they trying to get at? Understand what their expectations are. The other thing is making sure that it's done with a degree of authenticity and understanding what people's intent and expectations are in connecting intention with being authentic. I don't think it's a matter of picking out a particular factor and putting everything else to the side, like saying, we are only going to focus on diversity and inclusion in corporate leadership. That's a very important thing. And there are actually a decent number of studies at this point which show that more diverse and inclusive boards and C-suites tend to be companies that outperform. But going beyond that, if you are coming in as an ESG-oriented investor and saying, I have a particular fascination or interest in diversity and inclusion, when I'm saying that, I'm not saying I only care about diversity and inclusion. I'm saying that's the knob that I want to turn up the most. But I still care about the environment and ethical business conduct. Everybody optimally would have the same basic starting point, a kind of a tabletop ESG policy, which says we kind of generally agree that these things are important and so should be addressed across the board in a portfolio to a certain degree. And then you pick your spots from there so that you're broadly within the ESG tent. And then you decide, where are we going to go deep, or where are we going to seek alpha, or where are we going to take our risk or try to create a particular kind of impact. So hopefully that makes sense.
What are your thoughts about the SEC looking at having companies, or just to standardize the way companies report different ESG metrics?
Yeah, I think it was an inevitable thing that sooner or later the regulators were going to come around on this. Once the market and the academics and everybody else were able to provably assert that there was something material in those factors and that there was value in public reporting entities actually providing that, sooner or later, the regulators were going to come in and say there should be standards, there should be uniformity, there should be protocols around it, just the same as there are any other financial and other factors that companies are reporting. So I think the intent behind the creation of SASB and other frameworks like that was ultimately to, frankly, prod the regulators into getting there. Now, when regulators come in with a lack of understanding or a particular political cudgel, it can get complicated for sure. But I think it ultimately leads to a good place in the right place, which is a recognition that this information is important, it's material, it does affect securities prices and should be regulated.
You mentioned it a little bit earlier, and I thought it was interesting when we had our little prep call too, but the idea of shared value corporations, going back to this idea of perhaps companies that blend for-profit and non-profit exercises. Is it possible for a company to be both a profit seeker and a do-gooder?
Great question. Challenging one to answer in that, particularly when you're talking about something like shared value, that's really you kind of have to take the not-for-profit considerations entirely off the table. If you sat down with Professor Porter and had this conversation, there is no bleeding heart there. He is not thinking at all in terms of what greater societal good a company can do. He was looking at shared value almost entirely in terms of value creation in the corporate environment. I think we have to separate those to a degree. There are benefit corporations, B Corps, where it is possible to actually enshrine in the charter of the business that there are extra financial considerations that are stated priorities for the company. But beyond that, we've had corporate philanthropy forever, whether it's a separate foundation or whether it's simply just charitable gifts that companies make. That kind of stuff has been there forever, and we haven't sat and wagged our fingers at Coca-Cola or Credit Suisse or whoever it is for sponsoring a museum or an orchestra or the Special Olympics or whatever it is. And I think in fact, that's probably a good example in some regards, that even something purely philanthropic can create value for the company. So if your brand is on the Chiron for a charitable event, or it's on a banner, or brought to you by, well, that's a branding exercise. You've done good for the cause that you're contributing to, but you've done good for yourself. But looking specifically at shared value, what it's recognizing is that good ESG practices within the company are value creators, that paying attention to those things is actually just plain good business. The company will do better, both in terms of corporate performance as well as price performance over time by paying attention to these things. And some of that is through achieving greater efficiencies and product innovations. It can be managing risks that potentially could trip you up. It doesn't have to be a charitable impulse to say that we want to improve the waste stream of a manufacturer. That could just simply be a better way to run your supply chain, because you don't have to pay as much for complex disposal if you have more efficient manufacturing. Or if you're a purveyor of coffee and snacks, and you're bringing your stuff in through fair trade sources, and your clients or your customers are going to look more favorably upon that product because of the kind of the halo of goodness that comes from doing that. So yeah, you're making sure that workers in the food supply chain have safer working conditions, are better compensated, have greater economic opportunities, which is good for them and is a good humanitarian kind of impulse, but it's good business at the same time.
In your consultancy, do you consult with other fund companies and shops creating investment products?
Yeah, we consult with asset managers and fund companies. We also consult to wealth management boutiques, the people who are kind of in that middle space between the makers and the investors, trying to help translate what it is that investors are looking for into the language of the markets. So this is still a relatively new space, and I think it helps to have that kind of assistance there. And then we also consult with, it can be families who, they have wealth and they have a sense of purpose, but maybe they don't know how to translate that sense of purpose into, again, the language of the markets. Maybe in terms of their philanthropy they do, but how do you express those same priorities in the profit versus the not-for-profit part of how you allocate capital?
So maybe I can get a little bit of free consulting from you. If we were looking to do, or let's say a fund company wanted to launch a family of ESG strategies, would you recommend that they find the best one that they like and launch index-based strategies based on that one methodology? Do you think a fund shop could have multiple ESG methodologies that live under the same house.
Yeah, I do. I don't think, especially for multi-product shops, I don't think that having a single approach is necessary. There are a lot of different ways, as we've already talked about, to go about doing this, and it can also be different depending on what part of the market you're trying to address. You might take one approach if you're coming from an index and quantitative point of view versus a very bottom-up fundamental point of view, or if you're going after emerging and frontier markets versus developed economies. All of those, I think, are going to change the framework, change where the priorities are, change the available tools and resources that you have. So the market is not so vertically integrated that everybody's looking at it and saying there's one truth to ESG, and if you don't adhere to it, you are not up for consideration. There's a lot of room for a lot of different perspectives, provided that it's defensible. If it comes off as being thoughtful and well constructed, and to bring back a word I used earlier, authentic, I think the market will receive that well. And I think strategies that are brought online, which are cavalierly constructed in order to profit from a trend, but not with a lot of thought, not with a lot of grounding in terms of why it is what it is, they're going to struggle, because not only will they have trouble finding their voice, I think they'll have trouble performing as well.
Yeah, I would think that with all the different intentions that different investors have, having a nice suite of different approaches might work well for a company.
It's ideal for the marketplace, because we've got more and more investors who are waking up to this, and we don't need a monolithic solution. It's, to have a diverse marketplace is what's so great and so rich about what we've already had. So why shouldn't we have the same thing for ESG?
In the broad scheme of things, it doesn't have to be ESG. What's one long-term trend you see playing out over the next several years?
Well, this is probably going to be pretty cliche, but I think the demographic shift that we're undergoing is probably the single biggest thing right now. The transition from the boomers to the zoomers, basically. I think about my son who's headed back off to college here shortly, and they're the generation that's going to inherit what's left of the earth at this point. And they're going to have a lot of influence on consumption patterns and the way people interact and how markets function. I think what we've experienced in prior generational handoffs in the markets is going to move a lot faster this time. And I do think that ESG is actually a part of that as well. So this isn't going to be one of those things where Wall Street can sit and say, it'll sort itself out over 20 years as the boomers leave the marketplace and the Gen Xers head towards retirement, and I'll just sort of, it's now. All of the millennials are in the workforce, and they're the ones who are creating the wealth and inheriting the wealth, and the Gen Zs are right behind them, coming out of school, going into the workplace. They're beginning to consume, they're beginning to take jobs and create companies, and all of the economic power is rolling downhill towards these new generations. And there are more millennials than there are boomers. So, as I've been saying for years, ignore the millennials at your own risk. The next 3 to 5 years, it's going to be all about what they want.
So we do a segment called Trend or Fad. I'll mention a few different concepts. You can tell me whether you think it's a trend or fad, and you can explain it if you like. Single source coffee supply chains, trend or fad?
It's probably a little bit of both. People who are real connoisseurs, the same way that they are about things like wine and beer and scotch, I get it. If there's a particular hillside in Kenya, which produces a coffee bean that you really enjoy, sure. As a broad market thing, it's probably more of a fad.
Stakeholder capitalism, trend or fad?
That, I think, is definitely a trend. There's no question that people are starting to feel their oats and really understand as stakeholders that they have rights and they have responsibilities, and that the stakeholder community is more than just employees and customers and shareholders. There are a lot of different kinds of stakeholders, and everybody, I think, is becoming more wakeful to what that means. So I think there's a lot more yet to come, and probably a lot of arm wrestling to be done between the corporate community and civil society on that one.
And then blockchain-powered digital rights.
Yeah, I would say that's a trend. If you had said cryptocurrency, I would have said fad, but I think blockchain trend.
Mark, how do people find you?
Certainly on the internet. It's regenerativeinvestmentstrategies.com. There's a website, there's a blog, there's a variety of articles and papers and things like that are just out there for people to chew on and think about and respond to.
Thank you very much for your time. I appreciate you joining me today.
Yeah, thanks for having me. I'd appreciate it. This was a great conversation.
And thank you for tuning in to another episode of Trends with Benefits.